So thank you for being here, everyone. Big welcome to all who are here and all those who will listen to it later, the recording. So this session is part of the wellness series which FES Miami chapter is planning, and this is the first session which we are doing. And like it was mentioned in the emails, these sessions are geared towards the well-being of all engineers, not just from the point of all the technical stuff we do, which FES Miami chapter always promotes, but these sessions are geared more towards the personal development, the life skills, which could be useful in your day-to-day life. So, and dealing with all the stuff we all do. So the very first session is on financial fitness, and it's my pleasure to welcome Pedro. He has been a lifelong FES member and very active in FES. And to talk a little bit about him, I'll give a quick intro about him. So he's a lifelong learner and a teacher. He's worked 30 years at AECOM and a project engineer at SVP. And in 2018, he founded Zumocon, for which he's the president. And this firm is a management valuation and employee development consultancy. He is also co-created DICE, which is a holistic employee development program. He has his bachelor's and master's degree from University of Florida in civil engineering, Go Gators.
Yep.
And he has an advanced valuation from New York University and also leadership training from UCLA. So welcome, Pedro. Over to you.
No, thank you, and thank all of you for joining today. The our meeting today, we look for it to be interactive, as we mentioned before. We're looking to give away 2 books for those that get the first person that gets the right answer for the question. So with that, Tej, I'll ask you to just please in the chat see who in fact gets those answers first. And the purpose of the meeting is to talk about financial fitness. Being that as engineers, we have the opportunity to over our careers to make a good living, and then the key is what we do with all those revenues that we get, and how can we go about effectively utilizing them. So with that, first, just a quick disclaimer. This presentation is for general information and illustrative purposes only. It's not intended to constitute and should not be considered investment advice, and this material may not be shared or used without the consent of Zumocon. So thank you, Tej, for the intro. Bottom line is that, I finished graduate school in 1986, and my first salary was $28,000. I'm going to be pretty sure that everybody in this call makes significantly more than my starting salary. But as we look over careers, if you, rather than thinking of your salary on a yearly basis, think of your salary over a 10 or 20 year basis. When you start doing that, or a 30-year basis, you will see that income that you get as an engineer, as a project manager, a project engineer, and so on, is going to be in the 7 figures. So anyway, so we'll talk about how to best use those. So here's our first question. What is your most valuable non-renewable resource? So you can answer that question.
Anyone, feel free to unmute yourself and say it.
Yes. The winner is going to get a book, The Art of Defense by Whitney Tilson.
Jennifer answered in the chat.
Okay. Tesho, can you read me the answer?
Time, Jennifer.
Yes,
time.
That's the winner.
Oh.
All right, congratulations. So like I said, we'll be sending you an electronic copy of that book. So the most valuable non-renewable resource is our time. And as we think about it, in the way we go through our careers, we're effectively selling our, essentially whatever we work as engineers, we sell our time, and for that we get, we get income, in the form of a salary. And the key is, as we look at you go through your life, if you're able to then control your time and decide what you want to do as early as possible, probably would be, I would imagine a welcome idea. And that's what we're looking to do, is that when you're financially independent, then you can do whatever you want. If you want to keep doing consulting engineering, great. If you want to do something else, you do that. But I think the first framework is about what's most important, and have that understanding of time as a critical item. So we say that engineering consulting provides all of us the opportunity to be financially independent, which means that we just use our time in whatever way we want to use it. And the reality is that there's two of us. There's us, the engineer, the consulting engineer, and there's us, the investor. And if we're married, there's four of us. Or if we have a partner, there's four of us. There's two individuals that are getting a salary or own a business or are in some sort of profession that gives us income, and then we are investors. And when we say investors, and we'll describe later, is you invest as you have a 401k account, and which I imagine most of us would do. So think of this first framework. We have, let's say, the one that generates revenue and the investment side. So the keys to financial fitness can be, let's say, summarized in three key items: counting, saving, and compounding. We are going to, as we discussed, we'll show that the engineer side of us does the counting and the saving, and the investor does the compounding. And we'll explain what that compounding is all about. So the counting, and I guess coming from an engineering profession, counting, in spreadsheets and so on should be something that is, something that we usually welcome. And bottom line is that first we need to measure how much we earn and how much are we spending. That could be monthly, quarterly, in detail, less detail, depends on whatever works for us. But essentially, get away from mental accounting and just put it in paper. And track your progress. Essentially, as you go through the years, you go and say, okay, well, what are my assets? What are the things I own? And liabilities, what are the things that I owe? The second item is saving. And saving simply happens when you spend less than you earn. And if you consistently spend less than you earn over time with the investing, it's remarkable how your financial fitness improves. So we have a different formula that we propose for savings, which is income minus savings equal expenses. So what we suggest is whatever income we have, we set some target for savings, and with the remaining is that we tend to the expenses. And we think that is a way in which, like I said, paying ourselves first or taking care of ourselves first over the long term is very, very useful. And then in terms of the expenses, we prioritize in order of importance. Of course, being the house or the place we rent or own first, transportation, healthcare, food, and so on. And then things that are discretionary, so what I mentioned are more fixed costs, and some of them that are discretionary, like, say going out to dinner or get coffee. So we suggest that in order to optimize our saving is to make it automatic, effectively remove ourselves from the equation. Because most of the problem generally is related to us having a hard time effectively putting the money away. And when you pay yourself first, you make an automatic deposit, you take yourself out of the picture. And as you make it automatic and over time increase that, it just adds up and adds up. Also, fortunately, in the US, we get free money in many of the companies we work for. where, for example, on the 401k, which is a retirement vehicle, many companies match whatever money that you put in. We call that free money. And then also the government, through some tax-free like Roth IRA or tax-deferred accounts, like I said, like the 401k, you are able to delay payment of the taxes and therefore allow the money to grow. Also, there's an item called the health savings account, which is an account that you can have, provided you have certain type of healthcare coverage. You're allowed, the government allows you to save in an account that you can invest over the long term, and therefore you're able to, and from the moment that you open that account, you're able to get reimbursement. So rather than go ahead and using the expenses now, so let's say you pay for your healthcare expenses today, you save the money, let it compound, and years later you can use those funds. So you let that money compound. So for example, if you were to have in a health savings account $10,000 that is invested, let's say at 7% over 30 years, as we're going to learn a little bit later in the presentation, is going to be a lot more than 10,000. And so that understanding that healthcare is a major expense for you, these health savings accounts are very, very useful. And just briefly on these health savings account, you're able to do tax-free contributions, so you pay before tax, and then the money is allowed to grow tax-free, and then you can remove it tax-free, particularly for healthcare expenses. And so there's some details on this, but bottom line is that this is a very, very useful way to be able to grow a retirement account. And as we mentioned, just to close this HSA, these contributions are not included in taxable income. They grow tax-free, and therefore, and like I said, after 65, they're penalty-free. So it really makes it very, very easy, for you to save. So talking further on the investor, while you work, your money is working for you as compounding works on your investments. So you're gonna say, what is compounding? What is my money working for me? So compounding is our money making money for us. So when we have our 401k account, those funds get invested in companies, those companies grow, and therefore our money grows. And Albert Einstein is been said to say that compounding interest is the eighth wonder of the world. He or she who understands it earns it, he who doesn't pays it. And the magic of compounding is shown in the bottom here of the graph, where you see, how this 1, 2, 4, 8, 16, you see how these numbers, as they double, they go ahead and they grow exponentially. So if you look at the next, so let's imagine that this is $2,000 instead of $2,000. 4,000 could become then $128,000, which then if you double it twice again, that becomes 256 and then 512. So you see how this curve, it's just amazing how it grows exponentially. Here, for example, is 20 years. If let's say you have $1,000 over 20 years, grows up to be $7,500, so 7.5 times. And that's what's amazing about compounding. And then what that allows you, and if you recall, I mentioned that there's two of you, right? There's the engineer and there's the investor. Eventually, with investing, this money grows and grows and grows. So eventually the investor side of you may eventually tell the engineer side of you, you know what, you don't need to work anymore for money. You may work for other reasons. And that's sort of the idea, is that eventually the investor becomes a more important part of your two selves. So now we're going to share with you a concept of the rule of 72. This rule of 72 indicates how many years does it take for your money to double. So the rule says that you divide 72 by the rate of return of the investment, and you get the number of years to double the money. So let's say if I do make a 10% return, so how many years, if I make a 10% return, how many years to double my money? Can somebody place that in the chat, the answer?
No answers yet.
Okay. So rule of 72, how many years it takes to
Joanne
double?
says 7.
That's right.
Oh, that's right. Okay.
Right? 72 divided by 10, 7.2, roughly 7. So essentially, if you get a 10% return, your money doubles every 7 years. Okay, so if we save, so let's say if it's 7%, right? It's roughly 10 years, right? 72 divided by 7, 10 years. So it's, so the return of the money shows you, how quickly you can go through that compounding. All right, so here we go. Here's the second question, and this is for the second book. Compounding example. So Susan has a salary of $100,000 and places 7% of her salary in her 401k. The company matches 3% of her salary. So then she invests in a fund that gives her 7% for 30 years. So how much money does Susan save? So how much money does Susan have after 20 and 30 years? So Susan has a salary of 100,000, right? And she places 7% plus 3 that the company matches for her. So that's 10% a year. And then she invests that and she gets 7% return for 7 years. Excuse me, 7% for 30 years. How much money does she have after 20 and 30 years?
I guess everybody is working on with their calculators. You're really bringing out the engineers in us.
That's right. Well, remember the rule of 72, right?
Yes, yes.
We just explained the rule of 72. So let's see if anybody remembers that. So 72 divided by the rate of return gives me the number of years to double. And the answer needs to be approximate, please.
No responses yet.
Okay.
I'll take a guess.
Okay. So go ahead. Are you putting in the text in the chat, please?
Yeah, Sherry put 80K.
Okay, 8. Okay.
And Myra, we have another response. Myra put 40K and 80K. So I think the response is for 20 years and 30 years. Maybe.
Yes, correct. Okay, 40K and 80K. That's correct. That's the winner.
So but Sherry did say 80K. I don't know if maybe she was just replying for one of them. I don't know. So you decide who's the winner.
You know what we'll do? We have 2 winners.
Yeah.
Okay, that's what we're gonna do. And you'll notice that. So you essentially save 10,000 a year, And after 30 years, those 10,000 became 80,000. So imagine if you do that the next year. That's another 80,000 a year later. And imagine you do that the next year, right? And so what you start seeing is that the compounding, it really becomes, it's remarkable what happens. So for example, there's a platform called Enrich, that provides some insights into financial wellness that we think is useful. Additional learning for you. There's a few book recommendations. Psychology of Money by Morgan Housel. He also has a wonderful blog. Richer, Wiser, Happier, William Green. Poor Charlie's Almanac, Peter Kaufman. Seeking Wisdom, Peter Bevlin, and the Farnham Street blog. If you want to dig deeper, and like I said, we look forward to for any additional questions that you might have, and any additional books or resources. And here's our information to contact us. And with that, wonder if there's any questions.
Pedro,
Yes.
I was gonna type it, but I was gonna take long. For the 401k, is it best to invest as a Roth or like pay the taxes upfront or later?
Well, I can tell you what I did. One of the things that in my career, I used a combination of the two. So I think it's kind of an individual. I think it's that has specificity on the individual circumstances. But what worked for me is as long as I could use the Roth, because part of the challenge with the Roth is that there's an income limitation. So some people might not be able to do Roth, and it's so like I said, in my experience, I use both of them, and I try to max out as much as possible. So if you look at my saving career, once I got compounding, once I understood my 401k savings and Roth and HSA, all these vehicles started to go up. And then the result was also then the final number, the compounding numbers went up.
I know that the 401k gives you like a different profiles selections, whether you want to take low risk or up to high risk. So, I mean, the recommendation they had given is that when you're starting at a younger age, go with a higher risk to get more money returned. If that's still the recommendation, because I don't know about the selection of the stocks.
Right. Yeah. I think the one thing that that is critical in the 401k is how much time is there from today until the moment you're going to need the money. So generally speaking, and I've seen some companies that may have some funds that say 2050, essentially kind of tied to where your retirement is. And what I've generally seen is that the funds where people have a later retirement date, they tend to be, let's say, more inclined towards things like stocks and so on, that those might be, just 5 years on. So I think it depends on, where you are in your career. And so effectively, I think the fundamental issue is, when will you need the money? If you don't need it for a long, long time, at least what I did is, since I didn't need the money for a long, long time, I tended to not worry about volatility going up and down as much, because I was looking at 20, 30, 40 years on. And I think that was for me useful. I think that one of the key things for us is what is our behavioral makeup. If we are if something fluctuating a lot bothers us a lot, then that might be you might be want to pick things that are less volatile. But if you can handle things going up and down and just stay in for a long term, then you can take a more, what we might call a more aggressive position. But it really depends on what's right for each person.
We had another question, Pedro, which was, can I open an IRA account during college? Which was responded by Louis saying yes, just so that you know.
Okay, excellent. Yep.
Any other questions?
Are there any other type of investing type of sources besides 401k?
Yes, there's 401k, there's health savings accounts, which some companies have, some don't. We would encourage companies to have health savings accounts. Roth IRAs are another way, and Roth IRA meaning that you can go ahead and, for example, if you're for 2022 less than 50 years old, you can put $6,000 of your after-tax dollars, and those after-tax dollars grow tax-free. And if you're 50 plus, 7,000. Also, you can go ahead and invest in real estate. There's all sorts of different, ways in which, so for example, if you, many of us have, that have perhaps bought houses, when we go ahead over time, those houses over a long time go ahead and generally, increase in value. And, we had our challenges in 2007, 8, 9, and but anyways, like I said, over the very long term, you would see that is, real estate is another type of investment, and there's other alternative investments, but it depends on what is of interest. So there's many ways in which you take an investing, meaning you take your money and you put it into some sort of an investment that is going to give you more money back later. So, and the key there would be, what is the risk that I'm taking for that money coming back later? You can invest, for example, in savings bonds, treasury bonds, and those are, much lower returns, but you get those funds back.
Do you recommend those college funds or college investments for kids?
Well, let me tell you, I'll tell you what I did is I bought for my younger son, I bought the Florida prepaid. And I think if you go ahead and have, funds for the college, I think that's a good idea to save for college. I think that the fundamental issue with college, at least the way I thought of it, was what is the likelihood that college is going to be more expensive in the future? And what has happened through my, if I look at what I paid for a college credit at the University of Florida in 1982 versus today, 40 years later, it's a lot more today. And I go to 92 or 2002, 2010, it's been more expensive. In the future, is it going to be more expensive? If it is, then, I think that investing, for saving for college that way, I think would be prudent. And that's what we did.
Okay, if there are no more questions, should we go ahead and stop the recording?
Okay. Yeah, certainly. So thank you, and you know, please, you know, like I said, if you have any additional questions, you know, we'll be you know, pleased to follow up with you. So thank you
Sure.
very much.
Thank you, Pedro. And before everybody goes, I just want to share quickly the invite so that you all are aware of the next one which is coming. Oh, you can see, right, everybody? Yes. So the next one, the next topic which will be happening in Jan is stress less, relax more. So again, aiming more towards a healthier mindset, more towards how we can different tips and techniques on how we can relax more, you know, even while all the stressful work we do. Okay. And the link is going to be the same. So for all those who have registered already, maybe you don't have to register. You will get the information. We will send you the information for the next one. Okay. But the registration link is open, so you can the ones who have already registered might not have to register, but if you want to share it with somebody else and you think it brings some value to them and it will help them, feel free to share this with them and they can register using this link. Okay. Thank you everyone.
Thank you.
Have a wonderful rest of your day. Thank you, Pedro.
Thank you.